What's going on, guys? It's Josh from the Trading Fraternity. If you have not seen any of my other videos yet and you have questions after this, I encourage you to go watch those videos, see what remaining questions you have, because I answer a lot about penny stocks, options, and trading in general, and even Thinkorswim tutorials, all that. Take a look at them and come back to this video with comments, and I would gladly answer them and make a video. This was actually a comment I had in the video, and I hadn't really talked about it before, so I thought I would put it out and make a video right now about it. And what we're going to talk about is what common stock offerings are, how it relates to dilution, and how that even affects markets like penny stocks and options, especially penny stocks, because common stock offerings are often used and a lot of penny stock traders don't even understand what they are. But even in the course of just basic business, it's very applicable. This happened yesterday with Tesla. They offered, I believe, $250 million common stock offering. And that's a lot of money, obviously. It's funny, some new people in the news would say it's not big, but I even had some of the students ask me what it was and how this worked. So pretty much we're going to explain what happened and why it made the stock go up. Normally, this in most instances, it makes the stock go down, but this was a special scenario. So what happened was Tesla announced that they were going to offer $250 million of common stock. When companies use common stock offerings, especially if they're already trading, their IPO is the first time they ever trade. That's the first time they use the stock market to raise money. So every other company, as they grow in price and do other stuff, they issue more stock to raise money. So in Tesla's case, they need more money. They said it was to get a quote unquote cushion for what they were doing in terms of the Model 3 and to make sure that they had enough to produce and that any other issues would come up that would happen. So what it is when the company takes shares that was not already held by the public and they sell it to the public at the public market price. So Tesla's trading around like 263 right here. So 250 million shares. I think I want to say it's like 10 million shares or something is what they put out. I don't feel like doing the math, but they go and they take 10 million shares that were not already held by employees or were not already held by the public, and they issue it on the market. They sell it on the open market. They add shares to the float, the amount of stocks being publicly traded, and they receive $250 million, and now they have money to fund their business. That is it. That's how the dynamic of the stock market works. The companies use the markets to raise capital. Now, the issue with that a lot of people have, which why it causes stocks to go down most of the time, and people call it as dilutive because now there was only X amount of shares traded prior, but now they added more. So you could actually kind of see it here. This is from January. It hasn't updated, but even then, I think they did another offering around here. This is Tesla's outstanding shares. They went from 149 million being held in the float to, by January, 161. So that's adding more shares to raise money. So if you think about it, why it's dilutive is because now the minute they add more shares prior to the dilution, prior to the common stock offering, you owned, every one share you have, you owned 149th millionth of the company. But now when they add 10, 20 million shares, you now owe every one share equals 161 millionth, if that even makes sense mathematically. But that being said, anytime that happens, shareholders lose money, so they don't like it. But now in this case with Tesla, why the stock actually went up from it, because in that $250 million offering, right away, Elon Musk said he was going to be purchasing $25 million of that offering. So they were selling 250 million shares $250 million worth of shares they've never sold before. And Elon Musk was personally buying $25 million of that. So to him, it's not a lot of money, but to most people, they see that as a good sign. And really, it's a sign of good faith that he believes in it. And he's already a massive stakeholder in the company. So him buying more Teslas, despite the dilutive measure, people took it as very positive. And that's one thing to show with the stock market. It's not always about what happens, but how much the market interprets it, or how the market interprets it. So, water break. So that was really interesting to see. And a lot of people didn't understand why. It is totally normal. And Tesla's a new company. They came out in like 2010. And here's, a comparison. General Motors, Ford, and Fiat, they all have a couple billion shares outstanding. Tesla only has 161 million. So you will definitely see this in the future with Tesla as they keep growing over the years and need more money. I wouldn't be surprised to see them go get around 500 million, a billion shares outstanding. That's kind of the industry norm, because imagine General Motors, Ford, and Fiat as they were growing. They weren't as big behemoths as they are now, but they needed capital. And this is how they got the capital. And at the same time, if they took that capital and they continue to perform, Tesla makes those Model 3s, makes 16, $18 billion, shareholders are going to like that and keep willing to buy that price. So you just saw with the market that Tesla was, especially with Elon Musk's good faith effort to buy some of that and how much he's already holding, they saw that as a good sign and believe that it will lead to future growth and that it will actually return. I'm not too big of a fan of Tesla. I think if the Model 3 becomes successful, that will definitely change my mind. And if they could get on a course for making money, that's a whole other story. But fundamentally, they suck, and I'm not into investing in hope. So, and that's what a lot of people are buying it for. But to give a better example, imagine, and how I explain it for the students, because, I do a lot of private equity and I buy into companies. This even works in private companies and public companies. But what a lot of companies do, let's say you have a piece of your 100% equity of your company. Let's say it's a pizza, and cut it into 4 slices. So they give one slice to the CEO and founder, one slice to another investor, and then another slice to the public. So 3 of the 4 slices are held now by the founder, investors, like private investors and whatnot, and then the public. So 3 of 4 slices, that means 75% of the shares are outstanding. So what happens now, they keep a remaining one piece of pizza, that 25%. They use that as an options pool, and they use that to incentivize hiring employees. It could help them buy more stuff for their company, whatever they need it for. But usually they use it to either raise money on the open market or to hire employees. They'll say, okay, we have this piece of pizza, we'll give it to this employee, this good CEO to work for us. Or if they keep that 25% available, because Tesla in 2010 it IPO'd around like a couple bucks, and now it's at $200. So they kept that remaining 25%. So now that it's at 200, they could sell part of that piece of pizza and put it on the market and go collect the cash for it and use that cash as their business. And then that goes from 25% unused to a portion of the public, and now they have it. And even then, if you see with Tesla, they have 161 million outstanding, but it says the float is 127. So I don't know they're authorized how much they have available, but even by this, you could see that there's still 40 million shares outstanding, is shares held by everybody, including insiders and the public. Float is just the amount of shares held by the public. So by them, you could see the difference in the amounts. They have some shares, and sometimes Elon Musk will even give up some of his shares for employees or give up some of his shares to sell it and raise money for the company. But hopefully that gives you a little insight. And how it even relates to penny stocks is because a lot of penny stock companies, they use this now a lot more negatively, because even by itself, this has a negative connotation, because it's diluting investors. S&P, NASDAQ companies, they don't even like this stuff, unless you're buying 25 million of it. And what happens in penny stocks, this is how penny stock scams work. The pump and dumps, they jack up this price. They pay people to promote it, hype it up, say, yeah, I'm buying this. It's going to go to the moon. Look at this technology. Look at everything that's being done. But then when the stock hits, it goes up 1,000%. What the company does, they have billions and billions of shares they already have authorized and ready to go or outstanding. And those CEOs who are holding some of those shares, and then the company that has not utilized some of those shares, more often than not, it's the CEOs, the promoters and heads. They use that as an opportunity to offer more stock. There's even something called a shelf offering. You see that more with IPOs, where they'll even register the shares prior and even let people know, like even Snapchat has a shelf offering. I think they're even planning to release 236 million shares over 2017. So as the price is holding and gets to a higher value, what they start doing now is offering more shares to the public to quote unquote raise money for the company. And it's very dangerous in penny stocks, because now, think about the multi-billion share floats in penny stocks. A lot of it has to go through, and a lot of money isn't already going through these companies. If you go watch some of my other videos, I explain, you'll get some of these stocks only trade $500,000 in a day, if not $30,000 in a day. And how that's bad is because then what happens, you get these companies putting out these shares, and the demand for the market, even the people trying to buy at the all-time highs, it doesn't meet how much they're selling, and more supply drops the price of the share, and that's how it becomes dilutive. And now you already owned you already owned a thousand shares, a million shares of a company that has a 7 billion share float. Well, once they add even more shares, you own even less. So that's the danger of it. But I'll leave it at that. If you guys have any questions, let me know. I'm trying to keep these videos a little quicker. But subscribe, like the video if you liked it, and ask me questions. Like I said, go watch the other videos, see how, see if you missed anything, and if I haven't talked about it, and then come ask me, and I'll gladly make a video and answer it. So good luck trading. Be safe, be smart, don't be dumb, stay in school.